that key inflation data coming in this morning with December's consumer price index. While total CPI did hold relatively steady at 2.9% year over year, we did see core CPI come in better than expected on that year over year basis at 3.2%. For more, we're bringing in Aditya Bhave, senior U.S. economist at Bhave Securities. Aditya, good to see you here. So does this change your view, the data that we got today, about what the Fed may be doing?
Thanks, Julie. Good afternoon. Good to see you too. So it didn't change our view. We still think the Fed's going to be on hold going forward. I think what this report does, and it is undoubtedly good news, what it does is it trims the tail risks of a hike. So we have not been in the reacceleration camp. We've been in the sticky inflation camp. I still feel comfortable with the view that we're kind of stuck around 2.5%. That's where the Fed says we'll be at the end of this year as well. Right, so inflation stuck around 2.5. It's not necessarily reaccelerating, X of policy at least. And the labor market really seems to have stabilized. That's the big driver of our view. You look across the board at labor market indicators, and relative to what we knew when the Fed started cutting in September, they've all either stabilized or improved, which suggests to us that the Fed doesn't need to keep cutting. It's bought the insurance that it wanted to buy.
So Aditya, just to drill down on this point on the Fed's next moves or lack of moves, we had Claudia Sahm on the show earlier, Aditya, today talking about expectations for rate cuts ahead. I want to play you a little of what she had to say. Take a listen.
We are making progress on inflation. It's just very slow. So, this is not, cuts are not coming later this month, but that doesn't mean they aren't coming later this year.
So Aditya, Claudia Sahm saying, doesn't mean they're not coming this year, but you seem to take a different view of that.
Sure, happy to respectfully disagree on that. We think that inflation is somewhat stuck, right? So the first quarter data on inflation are going to be really, really important. That's when the base effects are quite favorable. We think we'll get down to about 2.4, 2.5% by the end of the first quarter, and then we'll just be stuck there for the rest of the year. Of course, if we keep moving down after that, or if we move down faster in the first quarter, then the prospects for cuts would increase. And if we, in fact, only ended up at 2.6, 2.7 by the end of the first quarter, then markets would move the other way.
And Aditya, so if you look at the longer-term inflation trend on a 3-month basis, and this is something that you had in a recent note, there is that clear sort of trend that's intact of disinflation, right? That it has come down, and then you're getting this stalling out. What are you going to be watching most closely, sort of as the inputs to see if we could either get a reacceleration in inflation or further disinflation?
Right, so I think it's dangerous to cherry pick components, but what I would say is on the reacceleration question, you probably want to watch services if you're worried about labor costs and you're worried about a very strong labor market, very strong consumer, then you would sort of assume that that would play out via services inflation, right? So you want to watch services. You probably want to watch auto prices as well. They've just been a little bit uncomfortably strong the last couple of months. We think this is a blip, but it's something worth keeping an eye on. And then in terms of disinflation, I would say a big contributor to that is potentially rent and OER. They, over the last few months, are just running around where they were before the pandemic. But if they move meaningfully lower, then of course it's going to be much easier to get back to target.
Aditya, now that we have PPI, CPI, curious, what are you looking for when it comes to PCE, the Fed's preferred inflation gauge? What are you modeling?
Yeah, we're looking for a pretty soft number. We're at 14 basis points on the core and about 24 basis points on the headline. So a 1/10 and a 2/10 with risks of each one rounding up to 2/10 and 3/10, right? But these would be soft numbers. They'd be good for the Fed. Again, the caveat would be put that in context of the fact that the last couple months we actually beat the comp, right? So the year over year moved up for a couple months and now it'll move down a bit. The broader trend is the year over year stuck at 2.8 for now, and hopefully the next leg down will come in the first quarter. So again, this one was mostly business as usual, slightly better than expected, but we're much more focused on what happens in the first quarter.